All right, everyone, let's kick this thing off. I hope everybody's having an awesome Thursday. I am really excited about this. We have three leasing experts here today. For the next hour, we're going to dig deep into leasing. I'll tell you what, I've gotten to go through the slide deck and see some of this. It's actually an exciting time to be in leasing. I think we had some slow times in Q4, so we know what that feels like. But the last two quarters have really come on strong. And so I want to introduce you to three people that are going to be basically leading the show here. I'm going to be emceeing the event. First one is Brett Drevlo. Brett is the head of leasing here. He's our director of leasing here at Evernest. And he is just amazing since he's come on board. We've improved leasing. It's one of those things where it used to be a headache, and now it's incredible where he knocks it out of the park. So you're going to learn a lot from him today. We also have Brian Shaw, who also works at Evernest, and he's director of pricing here at Evernest. So he thinks through our pricing and how we think about pricing these rentals. And then we also have Juan Burgo. Did I say that correctly, Juan? Yeah. Juan and I have just gotten to know each other. Juan is a new vendor for Evernest, or has been a vendor for Evernest for the last 12 months. And we got to meet in person a few months back, and super excited about him. He leads a company called Haven. As if you're in the business, you'll know they're doing a lot of the AI automation that's making leasing better and better. I think Brett's going to talk about where our leasing improved when his team got involved. So I'm super pumped about this. I'm going to shut up. I will be asking questions. So if there is a question button, you've been on a million of these Zoom meetings or Zoom webinars by now, but there is a Q&A function at the bottom of your screen. If you have a question, we can ask questions midstream here. I'll be emceeing the question. Feel free to pop that in. We also have some time at the end for questions. So I will shut up. Brett, I'm going to hand you the mic and let you take it off.
All right. Well, thank you, Matthew. And I got to tell you, man, these heavy intros that you load us up on, you're setting expectations real high for the crowd. So I got to figure out a way to deliver here. So, well, thank you for the kind words. Happy to share a little bit about how peak is going for us this year, peak season as we call it. So first slide here, I've got our average leads per property per month. The overall theme that we're seeing here is leads are up in most regions year over year. So against 2025 over the same period of time. I would say, I really love looking at leads this way, these bubbles on the map. It's the cleanest top-down read that we have on whether demand is healthy year over year to just stack up the colors and size of the bubbles on a market chart by chart, year by year. And we can see that things are just healthier this year. The headline, as we look through a couple of these markets here, Mid-Atlantic is the standout, up 8 leads per property per month year over year. It's a meaningful jump compared to the rest of the pack. Behind that, we've got Mountain 19 versus 6, Sunbelt, which is 23 versus 2, and then South just up modestly. Nothing too explosive on those items. An item to point out with Mid-Atlantic, I've been leasing in the Mid-Atlantic for 5-6 years now in my career, and Mid-Atlantic region continues to be one of the most stable regions through some of those big spikes and big valleys that you might have seen during COVID and right after COVID. Mid-Atlantic, for the most part, was just trucking through in a stable manner. We continue to see that here. So nothing too new there, but the rest of these markets are all rebounding well from a particularly slow 2025. West Coast is one to call out, which is down year over year, 31 versus 33. Although I would note, as you may notice by looking through some of the numbers here, it's one of our strongest regions on an absolute basis, has been since we onboarded most of these markets. So nothing too concerning there. We're just easing off a high number. I wouldn't call that to be overall weakness. So the takeaway here is volume's healthy. And we've broadly improved year over year, but the story is a little bit region specific. So I wouldn't let a strong national number mask what's strong or cool. That's particularly in the case here for the West Coast. And that's a good segue into my next item here. Let's talk specific markets. What are we seeing? Which markets are standing out specifically? This lines up well with probably the size and the kind of the deepness of the colors there on the visual. So here we're looking at leads per listing per month to versus 2025 peak, and it's just a market specific look. So the theme here is cool markets are bouncing back. So we've got particularly a couple of these markets had high deliveries in for particularly BTR and multifamily through the past couple of years, and we've seen some of the steepest improvements here, particularly looking at Phoenix. And then the two Texas markets, Dallas, Fort Worth, and San Antonio. So that's positive to see. So top of the board, Inland Empire, which is out there in the valley out in California. And then Dallas, Fort Worth, San Antonio, Williamsburg, and Phoenix rounding us out. What's interesting to me is that not only did these markets have quite a bit of delivery in the 2025, 2024, 2023, they continue to be supply pressured even today. So still working through absorption on that end of things. Brian will touch on this here, absorption pricing, kind of how all that layers in a couple of slides. Let's see. Inland Empire, topping out the list here. It fits the West Coast structure. Last year, we saw the same thing. Inland Empire was our top performing market in this time frame last year. It's also just a note, if you don't know the California market, it's Southern California's most affordable rental market. So there's just steady migration, and that's supported by just about any source you go look at. Williamsburg, which is up in the Mid-Atlantic area, continues to be stable. So that's kind of where that's coming from. Bottom of the board, a lot more to talk about here. Huntsville down 63%, Northern Colorado down 54%. Northern Colorado's been, that's Fort Collins, been having a particularly tough go. Tulsa, Jackson, and Chattanooga. So there's some nuance here. I want to make sure that these bottom markets aren't entirely misread. So a big drop versus a 2025 peak is not quite the same as a weak market, I would say. Very important distinction. It's a comparison to a market's single strongest stretch of the year is probably the way to think about it. So Jackson's a great example. Jackson's been one of our strongest markets as it relates to leads per property per listing in the country. Jackson very consistently holds up above 40 leads per listing per month. So on an absolute basis, they continue to do really well, even though we're having a slower Q2 season year over year. Same goes for Tulsa. Brian, do you want to touch on, I know you've got some more specifics on the Tulsa side real quick.
Yeah, Tulsa's been one of our stronger performing markets that we manage at Evernest. So especially over the last 6 months. So looking over apartment lists, just released some June numbers. They're showing Tulsa rents have appreciated 1.4% year over year. But since January, rents are up 1%. So that's pacing well ahead of where they were last year. Another thing, and we'll cover it later, I mean, Tulsa leads in the percentage of homes leased at or above list price. So we have good movement on the homes in Tulsa. Pretty confident in that market, at least in the short term.
Gotcha. Thanks, Brian. And one that I do want to flag to Northern Colorado, which is Fort Collins. We just call it Northern Colorado over here. Still working through record supply. So Denver and Northern Colorado vacancy hit 7.6%, 7.6% trailing 12 months, highest in 16 years with concessions at a 21-year record. So supply issues there. That we would expect that pressure to persist here through the remainder of the first half of the year. So for a couple more weeks here. And then I would note that the single family side is materially tighter than apartments. For those of you that are curious about that, single family vacancy is running around 4%. which is roughly half the apartment rate. So our product, at least in Northern Colorado, is somewhat insulated. So I'd approach this one cautiously. So while things, I think we have an optimistic look on it, we are having a tougher peak season up there than we were last year. Huntsville and Chattanooga are just smaller markets. They're choppier with smaller samples, I could say. I would just read into those as a softer spring than normal, but not overall too alarming. So the takeaway here is the markets that took the most supply pain last year are recovering really well. So that would be Dallas, Fort Worth, San Antonio, and Phoenix. So glad to see those markets bouncing back.
Brett, can I quick question? Three of the markets on the low end are in the South: Huntsville, Jackson, Chattanooga, and kind of Tulsa. I mean, it's kind of I would call it like a Southwest or maybe a Midwest market. But curious, if is there anything to that, or should people not read too deeply into that?
I wouldn't read too deep into it. I would say the May, June for the 2026 peak season, it's actually a touch slower than the earlier side of the peak season. We saw our peak. I mean, as you can see here on this chart, we saw our peak in the late February, early March timeframe, and then we've kind of rolled back from it, and then things are starting to pick up again. A little out of the norm when we kind of look at last year, we rose all the way through May. So I think we're just kind of seeing the normal year-to-year oddities in peak season. Still optimistic here for a rise into July, but from an absolute standpoint, when we look at the South here on this line chart that I've got in the middle, we can see that the South is kind of sitting right in the middle, right above the dark blue I've got is all Evernest. The South is still just a touch above Evernest's absolute, or I guess our overall portfolio average. So I wouldn't read too much into it with just normal market-to-market slowness. So,
and two things for the audience: if you will chat out what market you're in or maybe what region you're in, that'll help us give you some more context. It'll make the webinar feel a little more personal. And then also for anybody joining later, feel free to ask specific questions in the Q&A box.
Thank you, Matthew. All right, next one here. So leads that are applying quickly are more likely to be approved. This was an interesting one that came up in our review. So this one here, we're looking at approval rate based on how quickly a lead moves from the first inquiry, so date of lead creation, to a submitted application. So the bucket that runs from 0 to 3 days, all the way out to 60 plus days. So the pattern that we see here is the fastest movers are getting approved at the highest rate. So speed to lead, not only are we getting, is that where you get kind of just the most engagement, the most applications, but that's where we're seeing the most approvals. 4 to 7 day buckets is right behind that. And then we can see a bit of a drop off, particularly at that 31 to 60 range. So the volume is primarily front loaded. You might be noticing here, I've got the sample sizes right above the bars, about 12,000 leads in that 0 to 3 day bucket. So that's when we're getting most of our applications. This is all of our applications for trailing 12 months. So that's to get a sense of the volume. So most applications are happening quickly. It just reinforces really everything that we've been saying for the past year or so about speed to lease or speed to lead is the theme here. The 60-day bucket ticks back up at 47%, but it's a pretty small sample size, 53 leads. So I don't know that I would ignore the height of that bar, but you do have those folks that do look long range that are likely to be approved. So you've got some good folks out there. So the takeaway here is speed isn't just a conversion lever; it's a quality signal. So fast applicants are better applicants. At least that's what the data is saying. Leads coming in and applying within 0 to 7 days are where we're seeing the most approvals. So responsive follow-up, frictionless apps, frictionless application software, fast scheduling, all of that. It doesn't just close more. We're seeing that it pulls in more qualified renters at the end of the day.
And just a heads up to the team, we have a number of SFR investors and managers here. There's Midwest, a lot of Phoenix, Vegas, Atlanta, Denver, Colorado Springs, Athens, Cheyenne, Boise, Kansas City, and then there are all the Oregon markets, the Portland, and then of course just Tiana just said Chicago. So as y'all, we're starting to cover the whole U.S., but so you'll have some context.
Man, I love to see the spread of folks on these webinars. We're seeing it. We're tapping into more and more folks all across the country. Love to see it. Um, all right. So this one here, looking at leads and application speed. So what we're seeing is leads are applying measurably faster in 2026 versus 2025. They're not so much, we're not seeing them tour faster, but we're seeing lead to app, the velocity there, much like measurably faster. I believe that the exact number is 39% faster year over year. There's a lot that goes into this. So I'll try to kind of go through a few things. So one, I think the shape, for one, always tells the seasonal story. I always got to call out seasonality, the big kind of soft part in the middle there from September to January. Slow season, always you've got folks with relatively low urgency to move in those times. And then it's also a very competitive market in those seasons. So that's what a lot of that boils down to. And then coming into 2026, both lines, particularly the top line, the purple line, compresses pretty hard. And then just so I want to touch on a list of things that I think this connects to. One, we continue to improve our leasing software that we have here at Evernest. That's a piece of this. We're continuing to do more and more objection, overcoming, urgency training. We're finding continuous reviews of that more frequently than we've normally done in the past is landing well. Third, it's a great segue to introduce Juan, which I'll let Matthew do. We went fully live portfolio wide with customer facing AI for all SMS messaging at the very end of January 2026. So we're about 6 months into AI being plugged into all of our SMS conversations with prospective leads. So, but net here takeaway is the funnel's moving measurably faster. Would love to see if everyone else on the call is experiencing the same thing. Are folks applying from lead to app faster than in prior years? So would love to see if everyone else is seeing the same thing we are here.
Let me ask a follow-up question, Brett, and then we'll move. See if anybody has any questions too. But one question I had are the high lead per door markets like Inland Empire and DFW, are they converting at the same rate, or is the extra per home volume lower quality? Are those lower quality leads?
Yeah, that's a great question. Without looking too much at the details, we have it. I mean, we tend to see that renters in the Sun Belt and the South they kind of lead the way on lead to approval rate, so less qualified renter. Granted, we have slightly lower requirements there to compensate for that. They still continue to be approved at a lower rate. We see particularly higher rental debt and eviction related denials over there. So do we see, I would say that the overall trend of if you were to look at this market by market, you would see that folks are applying faster across the board. This walks nationally, but I wouldn't say that this always translates to approvals and on that end of things. So kind of taking apps submitted to the next step. So I hope that answers that question.
Yeah, that's great. I want to tell a quick story as I introduce our guest. When Brett told me we were going to do AI automation and text messages, this was something I got really excited about and probably annoyed Brett to no end, trying to ask him, when are we starting? When are we starting? And they did a lot of work, hard work to get it to the point where we could offer it to the public. Because obviously leasing, it's one of the lifebloods of our business. But when we first launched it, Brett was telling me that we had a number of applicants that had made it all the way through to applying, or prospects that made it from first contact to applying without ever touching a human, and that obviously excited me. And he sent me one of the chats between the AI agent and the prospect. And one of the cool things was the first thing was the prospect had set an objection, and then the AI agent overcame the objection. And then the prospect went to see the house and got to the house, and the lot box had an error message. And so they texted the error message to the AI agent. The AI agent researched the error message and told them how to get into the lot box. And I was like, this is the greatest thing ever. So I would say the guts or the pipes behind that is Juan's company, Haven. I met Juan through a mutual friend. I had this guy reach out and say, I know somebody that's doing AI and property management. And I said, I walk out on the street and I trip over people doing AI and property management. But he said, no, you got to talk to this guy, Juan. So Juan, because I connected with him and his team, connected them with Brett, and we've just had a lot of success working with Juan. And again, their company is Haven.ai. And Juan, I'm going to turn it over to you and let you walk through some of your slides.
Cool. Appreciate it. Awesome. Well, Matthew, thank you for the awesome intro. First off, thanks to the Everness team, Brett, Brian, Matthew, you guys for setting this up and letting me be part of it. Matthew shared a post on LinkedIn before this saying that hearing Brett and Brian talking about leasing is like hearing Beethoven discussing music. And I would have to strongly agree with that. These guys are a trove of insights. I'm not quite at that level. So I'm really here to offer a slightly different lens, right? Our team wanted to focus on behavioral insights by maybe zooming in one level, looking at the actual conversations happening with renters across Evernest markets. So we looked at about 17,000 prospect interactions across the Evernest portfolio, and we picked out 4 insights that we thought were worth sharing. And some of them weren't what we expected going into this. So I'm excited to go over them. And again, they're all centered around renter behavior, what people do, what they don't do, and what they're quietly signaling along the way. So let's dive into the first one here. Brett, if you want to go to the next, perfect. So the first pattern is probably the most intuitive, but it's also one of the most, I think, operationally important to property managers. And I'm sure this isn't a brand new insight for many of you. You've probably already seen this from your own leasing funnel, but I don't think many people have actually quantified this. So when we looked at new inquiries by the prospect's local hour of day, about 51% arrived outside Monday through Friday, 9 to 5. So arrived outside standard business hours. So the dark bars that you're seeing are standard business hours, Monday through Friday, 9 to 5. The purple is everything outside that window. So evenings, early mornings, weekends. So more than half of the first touches are happening at times when a traditional leasing team is either offline, unavailable, or just slower to respond, right? And it makes sense when you think about this from the consumer's perspective. People are looking for a place to live from their couch at 9 p.m. or on a Sunday afternoon because that's when they finally have a minute to think about moving. But this is a big number, and it has real implications on your leasing funnel performance. When one of these leads lands after hours, the typical wait for a human reply is close to 6 hours. By then, they've already messaged 3, 4, 5 other listings. And I think that gap between when the prospect reaches out and when they get an answer is one of the quietest places that we see leads leaking out of your funnel. I'm also sorry to report that weekday lunchtimes see the highest inquiry volume. So no one get mad at me if your boss is asking you to be responsive during lunchtime. I'm just a messenger. So great. So renters are inquiring at hours that are convenient for them, not necessarily for you. Naturally, the next question we ask ourselves is, when they do reach out, what are they actually asking first? And can that first question tell us anything useful? And it turns out it can. So this slide here looks at the first question a prospect asks and how often those conversations reach a concrete next step. So in this case, a tour or an application. So what we did is we tagged the first question a prospect asked in every conversation, and then looked at how often those conversations go on to some conversion. So what stood out to us is how much the rate varies depending on what someone leads with. So application process questions and fee questions are at the very top, both around 20% conversion. Tour requests, qualification questions, property detail questions cluster just above the baseline. And then lease terms availability, more general browsing type of questions, they sit well below it at around 7 to 10%. I think the important caveat, and I put it on the slide here, is that this is correlation, not causation, right? Someone who opens with a question about the application process was probably already serious before they typed anything. The question is reflecting the intent. So this isn't really a prompt to steer conversations towards certain topics. It's more that the opener seems to be a pretty reasonable early signal of where someone actually is in their decision making, which if you're triaging a high volume of incoming leads, especially in peak season, I think that's pretty useful for your team to know.
Were there any surprises of things that you would expect to pop up on a list like this that maybe land a lot lower than you might expect?
Yeah, I think I expected something like lease terms to be higher on the list, right? Because you think about someone inquiring and asking questions about the lease that they're like in the diligence phase. They've maybe looked at a couple of other places. They're further along in the process, and maybe they're trying to get a better sense of what clauses they're going to be signing on to. I also expected naturally that if people ask for a tour or if they have a tour request in their opener, that they'll probably convert. And, turns out it's the same thing like when you go on Facebook Marketplace and you have that pre-filled prompt that says still available. It's sort of just that, right? It's people just saying still available ? But never actually converting into anything. So I'd say those were the two that kind of surprised me for sure.
And one, I think it's really important. You mentioned like if you don't have AI that's responding to everything equally, then you do need to triage what you are, who you're responding to first, and that's what this high intent should signal, right?
For sure. Yeah. Like if you don't have something that's being responsive, 24/7, and at least having something that can triage and surface to you what the maybe more high intent leads might be so that your team can jump on them is important. Because again, that 51%, that's a big number, right? That has real implications on your leasing funnel. So figuring out a way to capture those leads as quickly as possible, I think is critical.
Something I want to call out from your prior slide too. You've done a really great job of mapping out when all these inquiries come in. I remember back maybe a month or two after we went live with our full portfolio integration with Haven, I went back and looked at, hey, what's actually converting based on their first inquiry? And what I found was leads that deliver their first inquiry to us at 3, 4, and 5 a.m. were like they were like well above the fold for net conversion, like ended up moving in at the end of the day. I thought that was interesting because when I saw that, when I saw, hey, there's a lot of people messaging us at 3 a.m., my reaction was like that's my 13-year-old brother looking around and just firing off messages like folks that are doom scrolling. And someone had pointed out that there's a lot of service workers out there that work overnight, or there are folks that just happen to have really early work days, and so having an agent that is responding to people continuously is such a value add. One, I have a question for you too. I think as property management companies have rolled out AI more and more, if I recall right, kind of when the whole AI virtual agent, even chatbot conversation started, there are many companies that consciously decided to not have AI responding to leads outside of business hours due to the risk of the customer might feel like they know they're talking to an AI. And I'm curious how that might be changing over a long period of time, where now it's becoming more and more acceptable and more people are willing to engage with AI. So turning on AI to engage with people in the middle of the night is actually a net benefit, and it's not being construed as like the negative side of someone being upset that they're engaging with AI and not a person.
Yeah.
Have you seen that change as well?
For sure. Yeah, we've definitely seen an evolution of this. I mean, we've been doing this for about 3 years now. I remember with sort of ChatGPT first came out and a lot of sort of chatbots were sort of being deployed across different verticals. Consumer sentiment towards AI was pretty low, right? Like people resisted these things. They didn't want to engage with them. Then like the underlying models got better and better, they became more natural, more useful to people. I think people became more receptive. Part of that is like it's sometimes indistinguishable from a person, especially over text or email. Like it's hard to know when you're speaking to an AI or a human. But I think general consumer sentiment, even when we look at voice AI, which is an application that we offer as well, people know that it's useful. It's not going to waste their time. They can probably get their simple query resolved. And so I think what we've seen the shift in property managers' mind be is just thinking about the opportunity cost, right? What's the alternative? How do you capture people instantly? You'd have to scale your headcount infinitely to be able to respond to renters or prospects 24/7. And so I think having something engage that renter, engage that prospect at the moment that they're interested is better than letting them go to voicemail or waiting in your inbox for 7 or 8 hours. And you can see it in the numbers, right? The numbers are the proof. The numbers show you that is an effective strategy. I think that there was a fear that maybe it would get in the way of human touch and human connection, but I really think if you think of it in terms of just a way to sort of increase capacity for your team and not necessarily eliminate human touch, I think that's sort of a good way to think about that.
Today's episode is sponsored by Crane. Look, if you've been in this business for any amount of time, you know how isolating it can be. When it comes to scaling past 200, 500, or 1,000 doors, the stuff that keeps you up at night doesn't always have clear answers readily available. You just have to know other operators who have been through it, and making those connections can be tough, especially if you don't know where to start. That's really what Crane is. It's a private, exclusive community for property management owners founded by Peter Lohman and Wolfgang Kroski. It's a place where you can ask almost anything and get thoughtful answers from other people in your same position. You can also browse other people's insights and get answers to questions you didn't even know you had on their website. They do monthly workshops, real-world dinners, and meetups across the country. Applications only open twice per year and spots go fast when they do. So head over to joincrane.co. That's joincrane.co to get on the wait list. If you're serious about running a real PM company, this is the place to be. I should tell them how we thought about human capacity too and what we did. It's a perfect segue to, instead of our team texting back, it like allow them to do more things.
Yeah, absolutely. When we began leveraging AI in our SMS conversations, the volume of our outbound calls to previously unengaged leads multiplied by four. So you think about in the past, I've measured what's the missed opportunity of a lead that you might have messaged or emailed, texted a bunch of times, but never had an opportunity to call. Those that are in the property manager operator seat know you just can't call every single lead you ever get as much as you'd like to. And so I went back and we had analyzed that the missed of all the leads that you never speak to, there's around a 20% missed opportunity. So 2 in every 10 leads that you had never called, if you had been able to call them, 2 in 10 would have converted to an application at the end of the day. And so what this allows us to do is it has allowed us to, instead of answering very repeatable SOP, what's on your listing, where's the application link type of questions, what's your qualification criteria, how do I schedule a tour? Instead of answering those very repeatable questions, we're now able to pursue leads and deliver more outbound calls. So that was the impact that we saw there.
Yeah, the only problem we have now is we're running out of houses to rent. So
yeah, it's not a great problem. So
all right, Juan.
Well, yeah. So this next observation was, I think, pretty surprising to us too, and it revolves around price transparency. Only 8% of engaged prospects actually ask about any cost or fee. And the more specific version of that question, what's the total amount I need to move in? It comes up in under 2% of conversations we looked at across 17,000. I think there's a lot happening in the industry around this right now, right? 2025 was a pretty significant year for rental housing regulation. There was a broad push at the state level requiring landlords to disclose the full cost of renting up front, not just the base rent. And I think the direction the industry is headed in is pretty clear. But this is really a broader consumer issue. There was a 2025 national survey from VTEX that found that 1 in 3 consumers felt frustrated by unexpected fees, and 20% abandoned a purchase entirely once they saw the real total at checkout. There's no particular reason to believe or think that renters behave differently. At first, you might look at this slide and think, okay, maybe price just isn't coming up very often. But I think the more realistic read is that a lot of price anxiety is silent, right? So the 8% who ask about cost are visible. You can engage them directly. What we don't have good visibility into is what the other 90% are doing with that uncertainty. They're not asking, but that doesn't mean that they're not thinking about it, right? Renters may be looking at the rent, thinking about deposits, wondering about fees, comparing move-in costs across different homes, but never actually typing the question into the conversation. And so that bigger group may just be the people who are worried about affordability, but don't say anything. They just may hesitate, delay, and disappear. So definitely, I think some food for thought there as we're thinking through, as the entire industry is sort of adapting to this new model of price transparency.
And one, I actually have a story about this. My son was playing baseball over in Georgia, and my wife and I at the last minute decided to rent an Airbnb. And Airbnb is promoting this like everything's included, all the fees, like everything is this one price. So we were looking and we chose one. And then we got to checkout and it was $200 more than what the and it was right because it was just taxes, but I got the feeling that one of our residents probably does, or our prospective residents does, where it's like, oh, I thought it was going to be this, and now it's this, and then it made my wife and I like have another conversation. Now we ended up renting, but to your point, it's like one more friction point that probably there's some subset of people drop out right there.
Yeah, definitely. I remember actually this with Airbnb when they made, I think this was a recent change in the past year or two, where they made the total pricing the default. And I think it was something like 300,000 listings removed or lowered their fees. And it became the baseline expectation across the platform pretty much overnight. So yeah, cool. All right. So next behavior here. What happens when a prospect stops responding? So in leasing, it's pretty easy to interpret silence from a prospect as disinterest. But what we're seeing is that a prospect ghosting you doesn't always mean that they're lost, right? We defined a ghost episode as any time a prospect went silent for at least 3 days after receiving a message from the leasing team. So of those prospects, 14% ended with the prospect coming back, about 1 in 7. And nearly half of those returns happened within the first week, which is what the purple bars on the left side of this chart are showing. There's also a long tail. So that large dark bar on the right is everyone who came back after 2 weeks or more. So the 14% number is worth sitting with, I think. It's not enormous, but it's also not nothing, especially when you're dealing with a large volume of leads. Now these periods of silence, I think they make sense when you think about how people actually search for housing. They may be comparing a few homes. They may be waiting to hear from a roommate or a partner. They may be checking their budget. They may be looking at school zones or commute times, or life just gets in the way for a few days and they're not responsive. So I think takeaway here is silence doesn't always mean the renter has decided against the home. Sometimes it just means the decision is sort of still in progress. And so continuing to engage that lead is meaningful. Which I think raises the obvious question. Does it matter what you send them when they go dark? So this slide compares the reply rate within 48 hours by the style of follow-up. And the highest performing one is also one of the simplest, a basic still interested check-in. So the highest reply rate, 41%, goes to what we're calling still interested, which it's just a short, warm message asking if they're still looking. Question specific follow ups where the message references something the prospect actually asked about earlier in the conversation comes in at about 38%. And then a call to action invite, something like want to schedule a tour question mark, are at around 36%. And then urgency and scarcity messages, those sit at around 29%. And then any sort of information updates, price decreases, sales, those come in last at about 15% here as well. So the sort of gap between a check-in and info blast is pretty significant, right? It's nearly 3 to 1. I think it points to that the fact that the simpler, more human messages are outperforming the informational ones by a pretty wide margin. And so those, there are many conclusions that you can draw about that one and what it means. But I think that was an interesting insight that we were also surprised with here.
Yeah, when I look at those first three, I think of it's like you're engaging the person, like asking them a question. And for people, it feels very open-ended to ask somebody a question for them not to answer, right? You send a text to somebody, it's like, you feel like you, as a person, you should respond to every text that comes in, especially if there's this loop open for a question. So there's a little psychology in the 41% and the 38%, I think.
It's very very low friction. It's very easy to opt into, and so it makes sense that would get a higher conversion there.
Brett, we did have a question come in from Andre. Remember going back to our story around the text messaging and when we implemented Haven and started calling back more people. How did we identify the leads that needed the callback?
How did we identify the leads that needed a callback? Haven's got some really nice functionality for this, where we're able to flag leads that we call high intent, or we have a notification escalation method. So in our integration with Haven, there's a long list of ways that people will escalate an issue to us. And there's, if I recall right, maybe 15 different buckets. And there's a configurable ability for us to identify, hey, do we want the AI to handle this and not notify us? There's another option of, do we want Haven to handle but notify? And then there are other options for, should Haven just hand this off to us? And that would be precisely how we identify who needs a callback of the people that engaged with the AI agent and had some challenges along the way.
Awesome. We have we're going to shift gears again, and we have a principle at Evernest called GSD. We make it G-rated, get stuff done, but it also means the other thing. And Brett gets a lot of the FaceTime and the glory for the leasing department, all of which he deserves, but there's also this guy behind the scenes that's he's the quiet assassin that's doing the killing on the backside, where that Brett like turns him loose on projects and things. And that is Brian Shaw, who is in charge of all of our pricing. And he and his team think a lot for our owners about where we should price units and are super strategic in how they think about that. So I'm going to turn it over to Brian and let him talk to some of the things he's been thinking about over the last quarter.
Yeah, thanks, Matthew. And Juan, thank you. That was super insightful. So let's jump into pricing. So one of the numbers I think we're watching the most closely, especially so far this quarter, is the percentage of inventory that leased at or above list price. So as you can see, 56% of our Q2 leases signed at or above list. That's up 17% from Q1. And every single region has actually shown improvement. So nationally, we can all agree. I mean, we're in a renter's market. We've got median rent throughout the country is flat to slightly down, depending on the index you're looking at. And Zillow just reported 40% of rental listings are offering a concession. So while driving these numbers obviously is impacted by seasonality, a lot of it is strong pricing precision up front. If you look at the data, the regional spread, it is a supply story. So Mid-Atlantic leads at 79%. Way I look at it, that's essentially because almost nothing new has been built there. So our top markets at Ask, you've got Tulsa, which I mentioned before, Baltimore, Richmond, Little Rock, Columbus. All of these are limited supply metros. And as a result, I mean, we're seeing flat to even positive rents in a lot of these markets. But then kind of flipping down to the bottom five, you've got Tampa, DFW, Houston, Austin, Colorado Springs. These are the exact markets I'm talking about that are really just digesting the construction wave that they've experienced since COVID. Austin is down over 5% year over year. Tampa, Phoenix, both in between 4 or 5%, depending where you're looking. Those are all the metros where like your original ask is really competing against that brand new product. And we're often seeing that brand new construction is offering really heavy concessions. So the good news, a lot of these markets are beginning to slowly see this drop off in new construction starts and then also apartment deliveries. So as that existing inventory slowly gets absorbed, we'll start to see gradual improvement, and hopefully that will impact this metric. So our softest markets are definitely speeding up. So when we look at time to lease, every market is beating last quarter's numbers. Again, seasonality at play. So as a result, I think year over year is the real signal that we want to pay attention to. What is interesting, I mean, a lot of our largest speed gains are coming from our most challenging markets. So similar to Brett's slide about leads, Tampa, one of our most oversupplied rental markets in the country. They've got elevated vacancy, declining rents year over year. That's our second most improved. So currently leasing 46% faster than a year ago. And if you remember from the previous slide, Tampa remains super challenging, especially when it comes to leasing homes at or above asking price. We believe, I mean, this definitely reflects a lot of the pricing strategies. We'll cover a bunch over the next few slides. But it's just proving, I mean, there's still ways to minimize your market exposure, even if downward pressure is really being applied to any specific market. Atlanta, that's our largest market in terms of unit count at Evernest. They're leasing 48% faster, really echoing a lot of the points I made about Tampa. But when you look kind of at the bottom of the data, the slower moving markets, the bottom three are still improving, 35% or more quarter over quarter. Our response rate, however, in my seat needs to be, faster price corrections, strategic use of concessions, and just really keeping an eye on it, but not panicking when you look at those markets by any means. All right. So this data, there's a lot here, so I'll kind of walk us through it. It shows our current price drop and concession trends. So for price drops, that's along the left side. We analyzed recently leased units. We broke them out by whether they leased with no price drop or receive various levels of reductions. For our concessions, also on the left side, we're looking at how many of our current active listings are offering any sort of concession. And then on the right side, we're showing how both price drop activity and then concession usage has really changed quarter over quarter. So looking at the headline numbers, 38% of our Q2 leases needed no price drops at all. That's up 25% since quarter one. And homes needing 3 or more drops fell from 39 to 22%. During previous webinars, and I think Brett's getting tired of hearing it, but we've highlighted the importance of really positioning yourself right out the gate with front end pricing. And our price drop data really tells that story. So in 2026, homes that priced right and took no price drops leased in a median of 15 days and at full asking price. But then on the flip side, homes needing 3 or more price drops actually took over 2 months to lease and ended up leasing at 12.5% below the original ask. So quite the difference. And what we're seeing, I mean, if you've got 2 to 3 price drops that you need to make, that typically means you weren't aligned on front end pricing, and you really lost that opportunity for high lead gen, especially over the really valuable first 2 weeks on the market. So once you have that problem, the way we see it, I mean, you've got a high days on market problem. Now you're essentially competing with your own market exposure and less about the price of the surrounding inventory. Um, on the concession front, so read the mix shift, not just the total. True rent concessions fell from 21% to 15%, while fee waivers rose from 23 to 36%. Now that part is deliberate. So the way we view it, a waived application fee will typically get a lease across the line and won't touch that rent number. And super important because the rent number is obviously what compounds every year at renewal. So especially at some of the lower price point homes, we find that these fee waivers, whether it be an application fee waived, can typically get a lot of homes across the finish line without touching the bottom line rent. And then lastly, concessions, they're not being evenly distributed across the country. Looking at industry data, certain metros are much higher than the national averages. So just reading a couple, Denver leads the way. They've got 68% of homes listed have some sort of concession. Charlotte, that showed up on our previous list. They are at 67%. Dallas is at 64%. So when you look at this data internally, I mean, half our leases need no concession at all. So we continue to perform at a pretty high level. And then this is really kind of the listing playbook. So in this slide, we want to dive into really kind of what trends we're seeing during the life cycle of a listing over and over again. Like what you do in the first 2 weeks, it's crucial for really determining how successful you're going to be with your listing. So we analyzed over 100,000 leads from 26. First week has drawn 2.3 times the leads of any other week. So this is the demand curve that we're legitimately seeing on almost every listing we've run. Typically, we'll define what we call a warm start as a property receiving 7 or more leads over the first week. The reason being, so we found on average 28 leads or so are needed in order to really lease a home. So if we can achieve 7 leads per week, we're really on track to lease within 30 days or less. Cold starts, we're always defining as 1 lead or less in the first week. They're almost never fixing themselves. So 87% of cold starts need some sort of a price drop, and they actually lease 4 times slower. So 1 lead by day 7, I mean, it's not bad luck. It's really the market is grading your price. We found by day 7, we have a pretty good pulse and overall understanding on the health of a listing. So that's really when we want to make our judgment on how to action on price.
Brian, question, why not earlier? If the first 7 days you're getting over 2 times and you're 3 or 4 days in and you've only gotten 1 lead, why wouldn't we think about doing that earlier? Have we seen some on the back end that have gotten the 6?
We have some of it comes down to just giving it that full week. You know, you want to give it a weekend. You want to give people time to not just see it on a syndicated website, but also get a chance to view it and process the listing. We've just found that that's enough time to truly like stick the flag in the ground and say, hey, this is the time that we want to action on it. We've given it enough time. If the price is right, it will expose itself as being a strong listing within a week. Plus, you've got things like weather events and various things that will heavily impact leads and showing volume, and we just want to give them a chance.
That's great.
I think this is the most interesting stat of the slide. So we've found a price correction inside the first 2 weeks will lift lead volume by 84%. However, that same cut made on day 15 or later lifts them only 49%. So an early drop will roughly double your lead flow within a week. And that's really the playbook. So price right to the market on day 1. Read the first 7 days like it's a report card. If that's cold, make sure to correct it within 14 days because that's when you still have your audience. Brett, I think you had a couple more things to add. Wanted to hand it back to you.
Yeah, I just, I sent you a message before the webinar and I said, please give me an opportunity to be a broken record. And so here's me doing that. So this is just another way to look at what Brian was talking about here. So uh, this is looking at, I suppose, your how many leads you are generating through the timeline of the first 20 days of your listing and how it plays out in days on market on a median basis. This is 12 months worth of data. So what we're seeing here is effectively the first 10 days should be a diagnostic in determining what actions you take relative to the pricing and concession levers that Brian's mentioned. So what we see is listings with really 10 or less leads in the first 7 days. There's a fold there between generating 10 or more in the following days. And so here you can see the line is, I mean, it's effectively monotonic. One early lead maps out to about 39 days on market. An early lead defined as a lead within the first 10 days. 10 early leads, it's about 28 days on market median. And then of course, 20 early leads, 28, 22 days, all of that. So it is a clean line. More early interest means faster leasing, really, is how I take that away. So the takeaway is it's the first 10 days, as I said, is your diagnostic. It is the market grading your price. And just a final item to that too. Do we see this everywhere? That's Matthew's favorite question. Are we seeing it everywhere? And we sure are. So this is just a look at some of our larger markets. In every single market across the board, I couldn't identify one where I didn't see a spread like this. It's not just a national average artifact type thing. It's holds true, and the gaps are fairly dramatic, as you can see here. So the spreads speak for themselves. Denver is 19 versus 58 days. Birmingham is 33 versus 68. Nashville, 22 versus 48, and so on. There's no market where early demand doesn't cut your vacancy roughly in half. So,
All right. We're going to round out this. Let me just do a quick Evernest promo, and then I have a few questions here at the end. Why do we do these things? Well, Evernest, we want to be thought leaders in the industry. We think that if we bring up the industry, it's just going to be better for all of us. So we love to jump in and do these types of webinars. We also have a couple of podcasts. One is for the industry. It's called the Evernest Property Management Show. If you're a property manager, it's a great way to learn how we built the business from the 30 doors that I owned up till what we are, tens of thousands today. And then we also have the Evernest Real Estate Investment Show, which it's an investor podcast built for investors. And then we also, like many podcast people, have a YouTube channel. We actually have multiple YouTube channels, but feel free to go on there for any more information around investing. And we're putting some heavy lifting into that right now. So, guys, with the 2 minutes we have left, I'm going to say a market. And then you give me a couple of sentences about what you're thinking about. These are some markets that were specific to the people in the audience. When I say Phoenix, what do you guys think?
I'll go first. Softening markets, days on market, homes are taking longer than they once were. Sun Belt, just grouped into the Sun Belt, we're seeing struggles on it.
I would also just add in the word improving.
All right. Brett, one you're super familiar with, Denver.
Volatile, concession heavy, sensitive.
What about like a free Epic Pass? Or is anybody giving that away?
I have to go find some free Roombas. I saw a free Roomba on a listing in Denver the other day.
There you go. Brian, Vegas.
Vegas, similar to Phoenix, seasonality always stronger than most.
All right. Another one not too far from you, Colorado Springs, Brett.
Ooh, more sensitive than Denver. Concessions are deeper. the build to rent inventory, particularly on the south side of town, uh, is putting a ton of pressure on assets down there. Um, it's just it's the spreads are insane for what you see. Brian and I were looking at a few listings a couple months back too together, and we were seeing very comparable homes with quite literally $1,000 difference, where a retail investor just can't compete with what some of these institutional shops have priced their assets at to move. So
Wow.
very sensitive market. Yep.
Brian, Kansas City.
Holding up well. Entire Midwest, super strong. Kansas City, 27% year over year improvement on days to, or on homes that are leasing at list price.
Brett, Oregon, all the Oregon markets, Salem, Corvallis, Portland.
Steady, both on the lead gen and days to lease, very like fitting in well with the Evernest average, but on the demand side, strong.
Two more, Atlanta, Brian.
Atlanta, surprised across the board at how strong it's been. Looking at the numbers last year, days on market improvement, lead gen improvement. Really happy with where we're headed with Atlanta right now.
And then last one, Chicago. Brett?
Trying to think. It based. I guess I haven't watched Chicago too closely, but very high level. It seems a little bit slower than last year, compared. The backside of Q2 year over year. Brian, anything on your side that may be more specific?
I don't have anything specific on Chicago. I can follow up with whoever asked about it though. Happy to dive in.
Yeah.
Awesome. Well, everybody, we went a couple minutes over. Thank you so much for coming. And we've recorded this. We'll send the webinar out via recording. We'll probably post it to the Evernest YouTube channel. Juan, thanks for joining us. It was great having you. Obviously, we're huge fans of Haven. So thanks for being here.
Thanks for having me. Appreciate it.
All right, everybody. See y'all back at next time. We do these quarterly, the leasing webinars quarterly. So looking forward to that for Q3 to recap Q2.